All right, we have your housing market update for 19 October. Man, we have one more full week in October, and I tell you, I cannot wait for it to get to November because that's my birthday month. And we'll be done with October because October is kind of sucked when it comes to interest rates. All right, so let's get into what's going on this week. A lot of news, and first thing up, prices. Prices are steady, but I think we're going to see prices come down. I think we're going to see prices come down because interest rates are up. Inventory's down. Existing home sales, we'll get into that. Also down. Interest rates up. Interest rates are up. We are at near 23-year highs for interest rates. 2000 was the last time we got above 8% for conventional. We're there now, conventional. So we'll get a little more into that. All right, so let's get into the headline news. Existing home sales, they drop. 13-year low. And home builder sentiment drops. Home builders aren't happy. They're sad fellas right now. 10-year treasury sprinting towards 5%. And then retail sales. Retail sales are strong. Jobs claims are low. And that's kind of the bad news that we got during this week that didn't really help interest rates and actually kind of sent them a little higher. All right, so let's go ahead and break some of that down. Existing home sales fell 2% month over month in September. Inventory right now, 3.96 million. That's projected annual. That's half of what it was in 2019. In 2019, inventory wasn't that high either. So super constrained inventory right now, and existing home sales show that. All right, so it's a combination of low inventory, you can't sell what doesn't exist, and high interest rates, you can't buy what you can't afford. All right, so inventory went up about 3% from last month. We're at about 3.4 months of supply. Normal is at 4.6%. Despite this lack of sales, this high interest rate, low affordability, 21 days on market is average. 21 days, that's it. Now, certain pockets you're starting to see more. Certain homes are going to stay on market longer. The ones that are not necessarily priced the best, and so that's going to, if you want to sell your home, you can do it. You just got to be smart about your sale. Let's look at the mix of buyers. First-time home buyers dropped 2% from 29 to 27% in September. Cash buyers, they went up from 27% to 29%. So fully, almost 1/3 of all buyers are buying with cash money. All right. Investors, about 18%, up a little bit from last month. So that's the mix. First-time home buyers still very strong, but not as strong, simply because of that affordability issue that we're starting to see. All right, home builder sentiment. Ain't no sunshine when the rates are high. All right, and that's no sunshine for anybody. Builder sentiment down at 40. Anything below 50, builders are negative. Builders are sad. And we haven't been this low since January 2023. And that was coming off of a really tough quarter, that last quarter of 2022. That's when interest rates first shot up to 7%, right? So that's kind of what we're seeing right now. And interest rates don't just affect the buyers; it affects the home builders. The cost for them to pay for people, to pay for parts, time is money. It's becoming more expensive for builders, so they're slowing down their role with building homes, and that's kind of why their sentiment is low. All internals, you're talking current traffic, future traffic, and then buyer traffic. All of that is down. So not very good from a home builder standpoint. And a lot of builders I've been saying this for a while now, if you can get into a new home, builders are incentivizing homes because they don't want to stop building and they don't want inventory to stand. So they're trying to sell homes as fast as they can, but they're really not building homes as fast as they can. All right. Treasury. All right. So this is something that everyone's taking a look at. Everyone says, "Oh, we're having a housing crash like we did in 2007." Well, it's totally different markets. The biggest difference being really inventory, supply and demand. We had probably 4 homes for every person looking back 2007, 2008. Now we don't have enough homes at all. So no homes. Normally, and you look at this, the Fed funds rate now in 2007 about the same. 10-year treasury, it's the same, but the 30-year mortgage. All right, 1 point difference, 6.7 in 2007, now 7.7. If you look at the spread between the 10-year and the 30-year, historically, that delta has been about 2%. Well, right now, we're closer to 3%. You can see that, the 30-year versus the 10-year, 1.84 to 2.84. But we need to get that down. And the reason why we have that big delta right now is because there's so much uncertainty in the market, uncertainty with what the Fed is going to do. The Fed, they talk through both sides of their mouth. They say, I think we're done. And then you get Fed Chair Powell saying, we may not be done yet. And you got the gal in San Francisco saying, we got to raise rates 2 more times. And that uncertainty causes a lot of angst in the market. All right, and then we still have a sharply inverted yield curve, and maybe I'll get into that next week. That inverted yield curve, which we got the hugest delta that we've had since it went negative, earlier this year, is coming back up. All right, we're almost the 10-year and the 2-year are getting closer to equal. All right, normally you want your 10-year yield to be higher than your 2-year yield, but it has not been the case. We're getting closer now. All right, so this is something we got to take a look at. All right, as that 10-year sprints to 5% with a 3% delta, that's why we're closer to 8% now. Maybe we should be closer to 7%, but with this 3% spread, we need to get that down. So there's nothing you and I can do about it. Individually, we can stop spending money and stop putting all of our debt into credit cards. But other than that, you gotta let the Fed do their job. Initial jobless claims. Today, Thursday, that jobless claims report came out, and we were back under 200,000 again. All right, not a lot of people applying for unemployment. Continuing claims up another 30,000. So that's 2 weeks in a row where people who are remaining on receiving unemployment went up 30,000. We're now at 1.73. We were at 1.7 million last week. But overall, just not seeing a lot of people getting laid off. But stand by. All right, that hammer's coming. And it's going to come right before Christmas, too, for a lot of people. All right, and I expect those people that don't get fired or laid off by Christmas, Happy New Year's, you're going to lose your job. All right, I'm not saying that to be a jerk. I'm not saying to spread fear. It's just the reality. Banks are going to start laying off. Real estate industry is already laid off. Just expect to see that, especially after Christmas. Nobody wants to get laid off before Christmas, and certainly employers don't want to do that. But under the fiscal constraints that we're under right now with higher rates across the board, it's not just homes, it's cars. It's a year ago, credit card interest rate 14%. Now we're at 25%. All right, people would max their cards out. You have $1,000 on your credit card, you're paying $250 a month in interest, just interest. That doesn't even include paying down the principal. All right, so that, my friends, is scary. That's the scary stuff. All right, let's get back to the initial job. So employers, they do not want to let go of their people, but they are tightening their belts. All right, and at some point, one notch is going to equal 1 or 2 people. All right, I think that's just the way it is. All right, so let's go. Mortgage rates, VA. All right, last week we were right near 7%. This week, 7.5 is what I'm seeing. Mostly conventional at 8%. What's keeping rates down? Fed Chair Powell said we have a long ways to go. Inflation still needs to come down. But many of his Fed presidents are saying we can hold steady in November. All right, we need to let the economy shake out. All right, we need to let the dust settle. And then obviously the terrorism in Israel and what is looking like a very bad international situation with regards to Gaza and what Israel's going to do. Those things are keeping rates down. And typically, when something like that happens, interest rates will come down because people are going to want to go and start buying more secure investments like treasuries and whatnot. So, but retail sales, we had a retail sales report that just blew expectations out of the water. We were spending money. All right, those credits, 25%, I've seen 29% credit cards. They're spending on credit cards right now. We don't have, our savings rate has dropped from an average of 10% savings rate before COVID. Now we're down like 3 to 4% savings rate. All right, Americans, we have the highest per capita income in the world. We have the lowest savings rate in the world. All right, go figure. We spend it. We really have never figured out as a whole. Some of us have, but as a whole, we haven't figured out how to save a little more than we spend. So that retail sales report on, I think it was Tuesday, man, that shot rates up. All right, That shot it up, and it was no fun. They were 10-year was off to the races. And then the job stability, just not the fact that unemployment has stayed so low. That just shows that people, companies, they're holding on to their people and they're not cutting enough costs yet. Unfortunately, I think the Fed wants them to cut. They don't want to cut fat. Right? They're going to cut into muscle and they're going to cut into bone. Right, we're going to see that coming up here. Certainly, if not by the end of the year, the beginning of the year. All right. So what does that leave us at? Hey, buyers, be patient. Affordability is so important, and certainly I don't want my buyers to get into a situation where they're going to be house poor. All right, ramen is great, but not for 3 meals a day. All right, inventory is not going to go up anytime soon. It really isn't. Actually, I take that back. If interest rates stay where they're at, if they stay in the 7s for a couple more months, you're going to see inventory go up. Not because people are selling their home. No, it's because people are not buying the homes because they can't afford to buy those homes. So, but don't expect inventory to go up. Cancellations are increasing. I'm seeing that every single day. Seller credit, that's going to remain a thing. Absolutely, it's going to remain a thing. As long as we have rates in the 7s, high 6s, you're going to see seller credits. Still a strong seller's market, but do not be complacent with the fact that you have a home and that your neighbor sold his home and that neighbor sold their home and made a ton of money. You may not make quite as much. Still going to do pretty good. All right. And anybody who's bought a home in the last year and they're trying to sell now, they're probably selling. They may have a pretty good rate. You can do an assumption and not have to come out of pocket with much money. All right. So make sure your buyer's agent, all right, is asking about the assumption, especially if that home was bought from 2021 on, because they don't have a lot of equity. They probably don't have a lot of equity, and you have an option. That's probably 2022. You're going to have an opportunity, if you have some money, to come in, buy a home, and get a rate in the 4s for another 28 years. So just something to think about. All right, that's all I have for you this week. I kind of ran on a little bit. Have a great week. Have an awesome weekend. Talk to you later. Aloha.